So we finally got the preliminary short form prospectus, and I want to go through the highlights and the tidbits that I found of interest reading through the 40-some page document. We kind of got the rough details of how much money they are hoping to raise. It wasn't as much as I had guessed in my previous video. I was hoping before that they would raise $40 million, and at $2 a share, there'd be about 20 million shares issued. We don't know the dollar price that the shares will be issued, but we know somewhere between 20 and 30 million is their goal to raise. There is an over allotment, so it could go a little bit above this number. Doing some of my dilution guesstimates, I just used the 20 and the 30 million to set my range. So I ignored, for the sake of the math, that it could be a little bit higher. They are going to pay 7% to the bank for doing for the money raising, or 7.5%. So they obviously don't come away with those total amounts. So somewhere between 19 and 28-ish million dollars is what they're targeted to get. So looking at the potential dilution, the shares today closed at $1.20. There was very high volume today. There was over about 130 million shares traded in the first couple hours. And then when I just looked, when I made the video, that only doubled by the end of the day, 260 some million shares. So there definitely was a bunch of selling to start the day, which makes sense. Particularly people don't tend to buy before a prospectus. You're going to get a better deal buying the shares in the warrant. So kind of using a little bit of a downside guesstimate. Hopefully it doesn't fall below $1 a share in the final prospectus. So if it did come at $1 a share, the minimum share amount would require about 20 million shares. There's 99 million shares outstanding, undiluted. So using about 100 million, so there'd be about a 20% dilution. If they do go to the higher, the 30 million, we're looking at about a 30% dilution. So it's kind of twice as worse as what I was hoping for when the share price was around $2. And I certainly think they could have used the 40 million, but with the share price dropping, that just wasn't going to happen. On the high end, if the shares did pick up, I wouldn't count on this. Best case scenario, the minimum shares require a 13% dilution. The max share amount, we're at about a 20% dilution. So this 20% dilution was what I kind of guessed before, but I was hoping it was going to be double-ish the money, or so, around 40 million. So some other tidbits we got from the prospectus. There were a few certainly things that I found interesting. This one isn't super noteworthy, but the company is planning to do that uplist, or hoping to shortly get a list on the TSX and then get their warrants listed on the TSX. Obviously, this isn't a guarantee and is talked about in one of their risks, as one of their risk factors. A little detail, unexpected detail on the warrants. So you will, if you get shares in the prospectus or in the offering, you'll get 1 unit. But you will also get 1 common share purchase warrant. And that was much more than I was expecting. Through Questrade, my broker, I was able to get shares in a prospectus for a totally different company, and I got a half warrant. And that's kind of what I expected, and right in the prospectus, that's what they gave with the previous share offering. Now they're going to give 1 full common share purchase warrant. So this shows, I'm guessing raising money is really brutal. I listened to the Alvin Podcast to learn a lot about how those 4 venture capitalists value both private and public companies. They certainly talk about tech companies really needing to tighten their belts, being really difficult to raise money, and probably being difficult for the next few years. So I assume this is an outcome of that. So again, this is from their prospectus. They highlight when they previous raised money last summer, and they only had to do a half common share purchase warrant. So that's what I was expecting, but not what we're able to get under these market conditions. Now, it's worth noting the exercise is $350 on those warrants. Tenet Fintech talks about potentially being able to get more cash on the exercise of these warrants, but we're nowhere near these being exercised. So it sounds nice that they could get another, I think 50 million, they say in the prospectus, from exercising these warrants, but that's not realistic or plausible in the short term. So they talk about what they're going to use the money for. So they break it out between China, North America, and working capital. We did get some cash burn information, and this 12 million isn't going to last long unless they get that cash burn down. So that's what I want to sort of highlight next. So as the date of this prospectus, the North American cash burn is approximately 2 million per month. Okay, so they're definitely burning through the cash. So that 12 million is only going to last 6 months unless they can get that cash burn down. Now, they're not generating any revenue yet, so hopefully they will start earning significant revenue to reduce that cash burn so they don't run out of cash. And that's certainly a worry I have, or certainly before this prospectus. If this didn't happen, I think Tenet Fintech was maybe not dead, but in deep trouble, potentially bankrupt. Okay, they kind of hint at that. Talking about that they only had funds for North American operations for the next 3 months. So their previous financial statements talked about having $15 or so million. They didn't break that down between Canada or North America and China. But this kind of gives us some idea. If they had 3 months at $2 million, they must have about $6 million of that 15 million they mentioned on the balance sheet in North America. So they're running out of money. They really need this. Here's the statement that the amount of cash they have doesn't take into account the potential 50 million from the exercise of those warrants. But again, they're $3.50. So certainly do not count on that 50 million, or certainly not in the short term. This is the usual kind of chicken and the egg situation companies like this can get into. If they can raise money, they can grow and get a higher valuation, but people know that they need the money, so you don't get the money at very good rates when you're desperate for it. So just a few more things I wanted to highlight. The cash burn was the most interesting for me. Johnson Joseph had totally ducked this question on, I think it was the Q1 conference call, or could have been the Q2, one of them, and he didn't answer the cash burn. So I was quite happy to at least see that number. Not happy with what the number was, but happy to have that info. Got a bit of information about the cash burn in China. So the Chinese operations are generating enough cash to meet its financial obligations in China, which is good. They may not be able to grow, but things aren't good. The markets were brutal today. We could be easily going into a recession. You need to survive. So if the Chinese operations are at least close to cash flow negative or positive or neutral, that helps at least the survival case. Okay, they really need the money to launch the business hub in both Canada and the US. So their net proceeds, they do mention both. So they're hoping or believing that $12 million will launch both, and that hopefully they don't need more money to launch the US operations. Now, I'd kind of missed in their previous financial statements them talking about being cash flow positive. Being cash flow positive from continuing operations in the previous quarter. Okay. But unfortunately, they forecast that they wouldn't see full profitability until the end of 2023. So I kind of went back, looked at their financial statements from Q2. And so again, this is from Q2, and their cash flow from continuing operations was a positive $3 million. So they're taking their loss and then stripping out all of the non-cash items, which is nice. It's math we would not want to have to do ourselves. So that was something I hadn't missed, and it's something to certainly realize. So this is from continuing operations. If you actually look at the total cash, unfortunately, they were down about $3 million. So they are still burning cash. So here's that $15 million cash number, and then I'm guesstimating the fact they have 3 months of money without the prospectus. 3 months times 2 million burn rate is about 6 million. So they probably have around 9 million in China, which they can't just easily move to Canada. It's hard to know how easily they can move money. They did do a transaction to move money to Canada before, but in their risks they talk about they can't guarantee that. So that's what I wanted to highlight. They're raising maybe half the money I'd hoped, but the shares had come down. We got some cash burn information. So where this leaves us is, well, I feel like China can survive on its own, so that's good. This North America, 2 million per month has to come down or they're not going to survive. They talk about having enough money to start their US operations, so they must be believing that this cash burn is going to come down. So that'll be really interesting as they get going in December. How quickly they can bring in money with the Canadian hub. So I think they're going to need more money. I think that's pretty obvious. They're not going to make it probably much more than a year. So we have no info on this Form 40. I don't know if they know. Is there hope that they're still going to do a U.S. cash raise sometime next spring? Probably is their hope. It certainly was their hope in the past. But there's going to be more dilution to come. Luckily, they are forecasted to grow at pretty high rates, so that does give us some hope or worth investing in this company. If they were going to grow at 20-30%, this would not be worth touching with all the risk. So just ending, I really would suggest you take a look at the Alvin Podcast. I first got on it sort of following Chamath Palihapitiya. And him and 3 other venture capitalists really talk about the public and private markets and tech valuations and how tough it is for venture capital and small companies right now. So one tidbit I got from this, they sort of talked about companies that are growing revenue at doubles, 100%, only being valued somewhere between 6 and 10 times yearly recurring revenue or annual recurring revenue. So that's probably a reasonable guide for us to sort of think of top end for peak. So the valuations of like Shopify trading at 50 times yearly revenue, those are gone. We're looking at max again in that 6 to 10. And these are for companies they talk about doubling revenue. So if you're a 20-30% grower, you are in trouble. The Alvin Podcast was a little more valuable a few months ago. They do more shows, so they used to be more dense and really informative. Now I just pick out select pieces of the Alvin Podcast. If you want to learn a little bit about how to value fast-growing growth companies, take a look at that podcast on YouTube. Hopefully this was helpful. I encourage you to put any comments. If you think I've done any math wrong, please let me know.